Welcome back everyone. This is an update on the oil market. Even though WTI's price saw a minor increase in the last 2 days, it followed up with an easing in the latest sessions and steadied nearby $41 per barrel. Despite the rather low price action by the commodity in the past weeks, fundamental developments in the oil market have prevailed, and this report aims to briefly outline the most important ones currently. As always, we start with the weekly readings from the US oil market, as the information could be used to make critical assumptions on where the market could be heading. Yesterday, the EIA indicated its largest drawdown in 2020, as according to its figure, crude oil inventories had dropped by minus 7.5 million barrels. Furthermore, the API, weekly crude oil stockpiles, also indicated its largest drawdown since the start of the year, with a figure of minus 8.3 million barrels. Both the pre-mentioned readings possibly support WTI's price, while on the other hand, according to Baker Hughes oil rig count, active oil rigs continue to be in a decline, with 4 less compared to the previous week, now dropping to 181 active oil rigs in total. Overall, we could say the readings tend to support oil prices, but the actual price action of the commodity could be still impacted by the oversupply we have seen prior to the crisis, in combination to the lower demand seen during the pandemic, which are still holding prices lower. On a different front, the OPEC Plus group has confirmed it will be enacting changes to its current strategy of balancing the oil market. OPEC, along with its allies like Russia, have been reducing output by minus 9.7 million barrels per day since May. As circumstances are seemingly changing and economic activity is lifted in most parts of the world, sending demand higher, the group looks more willing to relax its restrictions. The increase in production levels by OPEC is set to start in August. Expectations are that the excess supply will be easily absorbed as the global economy is picking up faster than expected, and oil demand may increase even further as we move into the fall season. The impact of the news tends to provide buying tendencies for WTI and for Brent oil. Other factors that point to stronger oil demand being currently the case is an increase in Chinese refinery activity in June. China's daily crude oil processing in June rose by 9% compared to the same month in 2019. In total, the Chinese have processed 57.87 million tons of crude oil in June, supported by increased activity in the construction and the manufacturing sectors. Moreover, today, other Chinese data like the GDP and the industrial output confirmed the Chinese economy is recovering swiftly. As a conclusion, the oil sector could be moving into a new era, as the electric car producing companies are seeing increased demand for their vehicles, and more automobile manufacturers are getting involved in producing their own models. What will be the impact on the oil demand in the next years as to the happening? Also, in the past days, reports on a unanimous plan by the largest oil producers in the world to bring down greenhouse gas emissions seems to have been set. Companies including Saudi Aramco and Exxon are part of this plan as the sector's climate awareness grows. Those were the fundamentals for the commodity. Please stay tuned for the technical analysis. Welcome back everyone. This is our technical analysis. This is WTI cash 4-hour chart. During July, WTI's price action has basically been between the R1 41.50 resistance level and our S1 39 support level, moving in a sideways motion. Even though both levels have been tested, they have not been breached in any case so far in July. Yet, if the commodity breaks above the R1 line, then we could see it move higher for the R2 43.45 level and even higher for the R3 46.20 resistance hurdle. In a possible selling scenario, if the commodity is to reapproach the S1 39 support level and it breaches it, traders may be interested in the S2 37.25 support line last seen on the 25th of June. Even lower, the S3 34.50 line could be used as a final stop point in an extended selling run. The RSI indicator below our chart seems to be in line with the sideways motion during the past weeks. Thank you very much for your time and enjoy solid trading.